Hello, and welcome to my video series on basic accounting. Now, I do want to emphasize that these videos are for individuals who are new to accounting or that would like to review basic concepts. If you're working on your MBA in a graduate program, these videos are probably not for you. However, if you are a high school student or undergraduate student, or more likely to someone out in the general population that wants to learn more about basic accounting, then hopefully these videos are for you. So let's go ahead and begin. In this video, we're going to be talking about one of the 4 primary reports generated by accountants, and that is the income statement. Now remember in my first video that businesses are involved in 3 primary activities: their operations, their financing activities, and their investing activities. And just to review, the operating activities are sort of the day-to-day selling of products or services, and then the cost associated with producing those services or products. Financing involves how a business finances its day-to-day activities. So it may take out loans from banks, the company may issue shares to stockholders, or a larger company may issue debt to investors. Now, the investing activities of a business are things that involve maybe purchasing equipment to produce a product, somehow investing in the business. Now, the operating activity, the financing activity, and the investing activities all create large sums of financial data. And today we're going to look at one of the reports that helps summarize that data, and that is the income statement. So what is the income statement? At its most basic level, the income statement is our net income, which equates to our revenues minus our expenses. So revenue in this case could be sales revenue if we sell a product, such as a supermarket, or it could be fee revenue if we sell services, like a law firm. Now, to create those revenues, we have to incur some expenses. So we could have the cost associated with producing those goods. And of course, we can have other expenses like salaries and wages and advertising expenses and all the office supplies we use around the office. And of course, we have taxes that we have to pay on our income. Now, over on the right-hand side, you will see a very basic income statement from the Hershey Company. And again, this is just an example I pulled from a textbook, so you can see exactly how a basic income statement is put together. So we have revenues, and in this case we have sales, because the Hershey Company mainly sells products like chocolate candy bars, which I'm sure we all know and love. And then to produce those sales, we have some expenses. So we have cost of sales, we have selling costs, we have certain interest we might have to pay, we have income taxes, and so forth. So once we subtract our expenses from our revenues, or all of our costs from our sales, we are left with a net income. And in this case, Hershey is left with a net income of $559 million. So our income statement is simply revenues minus expenses. So let me use an example we are all familiar with in our personal lives. If you are fortunate enough to have a job right now, think of your work and paycheck cycle. Let's say you work from June 7th to June 21st, and then you are actually paid on June 28th for those 2 weeks by direct deposit. And of course, during that time, you're also working from June 22nd to July 7th, which is the next pay period. Now, during that time, you have your mortgage payment or your rent payment, which is due on July 1st, so you have to pay that. And then on July 14th, you get your next paycheck into your bank account by direct deposit. And then about a week later, you have to pay your car payment on July 20th. So as you can see here, we have work occurring, and then we have paychecks occurring, we have certain expenses occurring, and while the way a business functions is not exactly analogous to that cycle, it does help us see how things occur within a business by looking at our own financial situations in our household. Now the question is, can you pay your bills when you need to? But believe it or not, the income statement does not help us necessarily with that question. Whether we can pay our bills or not on time is a cash flow question. And I'm going to spend the next couple of slides explaining the difference between income and cash flows because it's so important. Now let's look at this example. And this is the exact same cycle except I've switched a few things around. So now let's say we work from June 7th to June 21st. But now our mortgage or rent is due on June 24th. But we do not get paid until June 28th. So you can already see the problem that may arise here. Now, of course, we're working from June 22nd to July 7th. And we have a car payment that is due on July 12th. But we do not get paid until July 14th. Now think about that. Everything in here is the same except when our mortgage or rent is due and when our car payment is due. And notice that each of those events occurs a few days before we get paid. Now we've worked the same amount, we're getting paid for the same amount. It's simply a timing issue, a when issue. And the question is, can you pay your bills on time under this scenario? Now, since our bills are due a few days before our paycheck, if we sort of live and work on a paycheck-to-paycheck basis, we might have a problem because our bills are due right before our paychecks. And that's a good way of thinking about the difference between income versus cash flow. And I'm going to use some more examples to explain that difference as we go. Now, a transaction in a business is reported as income when the deal or the contract or the agreement is consummated. So if we are a producer and a company decides to buy a certain number of our products, as soon as that deal is in writing, the ink is dry, we can report that income on our income statement. Now, a transaction is reported as cash flow when that deal, contract, or agreement is paid. So until we receive the money for that order into our bank account, we cannot report that as incoming cash. We have reported it as income, but we cannot report it as cash that has come into our business. So think about this. A firm with high net income but poor cash flow may have problems financing its day-to-day activities if it is using its cash that's coming in to finance its day-to-day activities. So you can think of businesses that have billed customers for whatever service or goods they have shipped or provided, but they have not received the cash into the business for those goods or services. So companies that have a hard time collecting from their customers can be put in a real cash flow bind, even though their income is high because they've booked that income when they billed or the contract was agreed to. They haven't received payment for it yet. In business, we often hear the phrase cash is king because billing a customer or a client is one thing, but having them actually pay you is an entirely new thing, because you cannot do anything with that sale until you receive the cash. Once you receive the cash, you can go ahead and use that cash in your business in whatever way you deem fit. Income is not cash flow. And there are many people who open up businesses that do not understand this fundamental concept. It's one thing to ink a contract for a product or services. It's an entirely another thing to get the cash for it. So we've got to keep those two things separate. Now, there is a report called the cash flow statement, and a lot of investors that are looking to invest in a business or a corporation will just skip past the income statement at first and go right to the cash flow. Because in the cash flow, they can actually see what amount of cash is coming in and out of the business. And again, cash is king. So let's say you're a private math tutor. And to make things easier for the families you work with, you allow the parents to pay you at the end of each month for all 4 weekly sessions, which are $25 each. So you are working with the student 1 hour per week for $25 per session. So let's look at our income versus our cash flow. Now in week 1, we've met with that student, so we have booked income of $25. But we have not received the $25, so our cash flow is still 0. In week 2, we add another $25 of work, so our booked income would be $50, but our cash flow is still 0. Week 3, $75, cash flow still 0. And then finally in week 4, we have booked income of $100, and our cash flow is finally $100. As long as I do not mind waiting for the cash to come in at the end of the month, everything is fine. If I have bills to pay along the way, which of course is real life, we do, then I might have a problem with cash flow because I have obligations to pay cash out to someone else. So here you can see the difference between booked income, which is work we've already done but haven't necessarily been paid for, and then cash flow is when we were actually paid for our work. And this is just a simple example to explain the difference between the income statement and our cash flow. So here is our example again from our previous work cycle. So we work from June 7th to June 21st, and we can book that as income because our employer has agreed to pay us for those 2 weeks, so we can book that as income. Then we get paid on June 28th by direct deposit. At that time, and at only that time, can we count that as a cash inflow. See the difference? Now we work from June 22nd to July 7th. That's 2 more weeks of booked income. And then on July 1st, we have to pay our mortgage or our rent. And that is a cash outflow. On July 14th, we are paid again, which is a cash inflow. And then we pay our car payment a few days later on July 20th. That's a cash outflow. So the income is only counted when we actually do the work, or we ink the contract for a certain number of goods, or we sign a contract for certain services, maybe like legal services. But we cannot count that as cash on our cash flow statement until we are actually paid for it. So again, this is just putting the difference between income and cash on our example we used earlier. So here's an example of an income statement. This is simply the blank template that Excel has for an income statement. It's really easy to produce because it comes with the program. If you look at it real quickly, at the top we have our revenue, which is always at the top of our income statement. And in this case, we had gross sales of $500,000, and then we had some returns and other allowances that reduced that net sales to $300,000. Then we have our cost of sales below that, which would include things like inventory, new goods we've produced, and at the bottom of that we have sort of a gross profit or loss. Now it's called gross profit because we have not subtracted out our expenses. So below the cost of sales you will see operating expenses. And those are all the expenses we incur to produce the sales at the top of our statement. So we have salaries and wages, advertising, payroll taxes, office supplies, etc., etc. So all the expenses that we incur to produce the sales above. And again, it's just a simple case of subtraction. Our revenue minus our cost of sales and expenses. And as we go down, you can see the net income for this fictional business was $47,000. So even though our gross sales was $500,000, after we subtracted out all the returns and allowances, the cost of sales, the operating expenses, in the end, we were left with a net income of $47,000. So here's the revenue line up close. You can see gross sales of $500,000. And I did forget to mention that the first set of numbers are for the current month, and the right-hand column is for year to date. So they're representing the same information, it's just a different time period. So for the month, our gross sales were $500,000. We had returns and other allowances that then reduced that net sales to $300,000. Now below that, we had our cost of sales. So our beginning inventory at the beginning of the month was $350,000. We manufactured another $120,000. So our total goods available was $470,000. Then we take out our ending inventory to balance all that out. And over the course of the month, the total cost of the goods sold was $110,000. If you notice, our profit is our $300,000 in net sales above minus the $110,000 cost of the goods we sold, and that left us with a $190,000 gross profit for the month at the bottom. Now, of course, from our gross profit, we have to subtract our operating expenses. So salaries and wages, commissions, depreciation on maybe our equipment. And then, of course, we have rent, utilities, office supplies, postage, all kinds of things. So once we subtract all of our selling expenses out, we subtract our general and administrative expenses out, we have total expenses of $121,000. Now remember, our gross profit above was $190,000. So $190,000 minus $121,000 in operating expenses equals our net income before taxes of $69,000. Then we have to pay our taxes on that income. So our net income after taxes is $47,000. And that is our net income for this time period. Total revenue minus our operating expenses and our cost of goods equals our net income of $47,000. So let's go ahead and do a quick review, and then we'll be finished for this video. Just remember that the income statement reports are sales and or fee revenue. Now it also accounts for the costs associated with generating those sales. So if we produce new inventory, if we produce new product, there is a cost associated with that production, and we account for that in our income statement. We also account for the expenses associated with generating those sales. So salaries and wages, advertising expenses, taxes, office supplies, all those types of expenses most of us are familiar with. Now the income statement does not report, and I cannot stress this enough, does not report if cash has been received for those sales. So receiving the cash for a sale is not the same thing as maybe signing a contract and booking that income. It also does not account for if cash has been paid out for those expenses. So we may incur an expense on our income statement, but until we actually pay that expense, it does not count on our cash flow statement. So cash flows is really, literally, cash in and out. Cash flow. Cash comes in, cash goes out. Cash comes in, cash goes out. The income statement only accounts for whether or not sales have been booked or contracts have been signed, and the expenses or costs associated with producing those sales. So always keep that difference in mind. Many people confuse the income statement with the cash flow statement. They are related, of course, but they are two different things. So we have come to the conclusion of this video. Again, thank you very much for watching, and I look forward to seeing you next time.